Welcome to the daily update, where I'll go over the action in the market for Friday, June 13th, and we'll see how things look for Monday, June 16th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, had a down day, not a real surprise. What was kind of a surprise is we saw the buy the dippers come in not too long after the open, and they gave it a good shot. They really tried. They came in at a round level that I'll point out. We went up to a round level, and then the smart money came in and said, okay, we're going to do more selling now, and pretty much wiped out anything the buy the dippers were trying to do. Now, for right now, it looks like a pullback. We're still positive in the short, intermediate, and long term. We're not showing really any positive short-term momentum currently. We actually have one extreme negative short-term indicator right now that I'll point out. So for right now, it just looks like a normal pullback. After we've been going up and up and up, and everybody started to assume that we were going to keep going up and up and up, well, that's when usually the party is about over. Now, this is a crazy weekend. There's a lot of things happening. What happened from Thursday night into Friday is Israel launched a preemptive strike against Iran. Iran is trying to retaliate. So far, it really hasn't been the retaliation from what I've seen. There's some injuries and damage, but it hasn't been that big of a deal. But that could change at any time. There's all the protests happening in the U.S., and now that's going to include Israel, because you'll get the folks that are going to bash Israel for defending itself. That always happens. That's pretty much a given through thousands of years of history. So just expect that, but we'll see. Is that going to cause some kind of a problem over the weekend to make things more negative when we open back up on Monday? We're not really going to know until the futures open Sunday evening to see what's happening there. Are they going to react to it? Is it going to be positive, negative? There could be good things that break out over the weekend, but right now it's kind of negative with what's happening geopolitically and then domestically in the U.S. Okay, so right at the open, we had a gap lower open below S1, 6,018. So we started off above the 6,000 level, and we actually opened a little bit higher than what the futures were indicating we were going to open as. But then we quickly saw declines after that. We went down below S1 at 6,018. Then we broke below 6,000. We hit S2 at 5,990. And we went down, this is the round number I was talking about, right at 59.75. And we found some at least short-term support. And it looked like, okay, maybe there's a shot at turning this thing around. We were able to rebound back above S2. We got back above 6,000. We got back above S1. Then we hit resistance at another round number, 6,025. So that pretty much dealt with the open. The first 1, 2, sometimes maybe even 3 hours. Those are the amateurs coming in and doing what they're going to do. Then later on, and this is why I break it down into two separate sections in this particular slide. Then the smart money said, okay, we're going to sell. So prices declined back below S1, back below 6,000, S2, even broke below 59.75 to set a new intraday low. And then we just chopped after that, just kind of bounced around, and we closed slightly above the intraday low. So on a percentage basis, yeah, we were down over 1%, but it wasn't really drastic. We've been down more than that just in normal days. So we were down 1.13%, below average volume though. We didn't see it really pick up. And as I said, we're positive in the short, intermediate, and long term. We're getting things kind of reset a little bit right now. We're not too far away from the 20-period moving average or the 50-period moving average. We worked off that. A lot of the short-term extreme conditions have been worked off now. So Are we going to shift and look more negative, or are we just going to see a pullback before we get set to go higher? Right now, it just looks like a pullback, but we reevaluate this at the end of each day and say, okay, what's the climate looking like right now? All right, so some comments. Israel and Iran, the fear, the negative geopolitical news, which I always mention it in every video, but most of the time it's just like, just be aware of that. Well, Friday's session was where it seemed to come into play. So this fear and what's going on between Israel and Iran, that won over the fear of missing out, the buy the dippers. Oh my gosh, we're going up, we're going up. I need to buy, buy, buy. They tried that early in the day, but it didn't win in the end. Then there are fears that the Middle East conflict will escalate over the weekend. So you had some hedging going on, you had people shoring up positions and just saying, okay, there's a lot of variables out there, and we kind of have to default to them being negative variables. So let's just get out of the market. President Trump called on Iran to return to nuclear talks. This had been going on. There were deals out there, and there was a 60-day window that Iran had to try to work something out. And then when that 60 days passed, boom, day 61, that's when Israel goes in and does what they feel they need to do to protect themselves. But Trump also said, come back, let's talk about this or face additional aggression from Israel. But Iranian officials no longer plan to attend the nuclear talks. There were some scheduled for Sunday over the weekend. Apparently that's not going to happen now. And then Iran fired missiles back towards Israel, giving the market little hope for de-escalation. So in the wake of all of that, we saw areas that have been a little bit stronger lately start to pull back. Techs and semis, they didn't have a good day on Friday, and that took the market lower. Because of what's going on geopolitically, because Iran has control of the Strait of Hormuz, and they're a big oil country themselves, oil really shot up. We'd been in the low 60s, and then we started to creep up into the mid 60s as the week was unfolding. And then when everything escalated, it shot up now into the mid 70s. And the VIX, we're back above 20 with the VIX. We're at 20.82. That's when fear is starting to increase, and we start to see negative annualized returns when we're above that 20 level with the VIX. The only thing that's overbought right now are the stochastics, and that's because we have three charts: short-term, intermediate short-term, long short-term, and those take a while to roll over, especially the longer-term chart there. So that's still extreme positive. Everything else has been taken off the list now. We still have our momentum oscillators that are just kind of floundering around, going sideways, starting to drift a little bit lower. And the bullish percent indexes really didn't move all that much in Friday's session. And we have one extreme negative reading that I mentioned, the Stochastic RSI, which after Wednesday was extreme positive and had been on the list for a day or two. Now it's extreme negative all of a sudden. So it's picking up some negative action. But we're not seeing that with our other short-term indicators. That's why I use a bunch of them to try to see, okay, what's the consensus of what's happening, not basing everything on just one indicator. No change with the Fed. They're pretty much in the background right now. They're going to be meeting in the upcoming week, and the market is anticipating that rates are going to stay the same. Of course, there's, Trump is out there, cut it 1%. He's a businessman. He wants interest rates lower. He wants to get the economy booming, so he can say whatever he wants. But the Fed is supposed to be an independent agency. Yeah, there's politics that goes into it, but at least on paper, they're supposed to be independent and just not be influenced by the Republicans or Democrats, the right or the left. They're supposed to just do what they think is best. All right, the dollar was up, so we did see a little bit of a rebound there. And interest rates were also up, though, but we're still under that 4.5% level with the 10-year yield. We came in at 4.42%. Now, one thing I pointed out yesterday, and then other videos that I post on the website, is one of the reasons I'm saying this looks like a decline, at least to this point. We're not seeing money coming out of the stock market and going into the bond market. And that's usually called a safe haven, a flight to safety type of a thing. That's not what happened. Bond prices went down, so interest rates went up. If they were pulling money out of the stock market, that would bring the stock market down. And if they were putting it into the bond market, that would push bond prices up, which would push interest rates down. Now, we did see oil going up, we did see gold going up, and those are the usual things that rise when there's geopolitical things such as we're seeing right now. But we're not seeing that shift that we were seeing back in March and into April with this flight to safety of stocks over to bonds. That didn't develop in Friday's session. We still want to watch for it, though, just in case it does start to turn into that. Sentiment is still positive. We ticked down a couple of notches, but we're still in that positive range at 60. We're still not trending. Now, it looked like after Thursday, it's like, okay, we have a shot of possibly getting the ADX to cross above its moving average. It was really close. You could even say it was a little bit above if you take a magnifying glass and look at it. But with the downward move on Friday, now we've kicked back down into more of a non-trending position, and we're below 20. So that also means we're not trending. With the down day, the bias is negative. I'm still keeping the momentum at mixed. We have a more positive backdrop. That's another thing that I was pointing out yesterday in the daily video and then other videos that I have on the website. Is what's the context when things start to look bad? And it was positive, even though we're not trending. The context is that we're still positive for right now, and so we lean towards that and say, okay, until proven otherwise, this just looks like a decline that we could possibly come up out of. Now we see more weakness. Things happen over the weekend. We see the futures gap down on Sunday, and we have another big down day on Monday. Plus, we're also starting to come into a more weaker seasonal time. The second half of June historically is weaker. So we'll see if it doesn't develop into something like that. Plus, we're coming into the summer months where people are on vacations, there's schools starting to let out, and there's usually a real drop off in volume. But that doesn't mean price is going to stop doing what it does. We've had some just wild summers as far as the stock market is concerned. Okay, so we just had consumer sentiment, which actually came in improved from the previous reading. I expected it to come in at 53. It jumped up to 60.5, and inflation expectations are starting to come down. So they had been at 6.6. The people were thinking that's what inflation was going to be at. It actually dropped down to 5.1. So this was taken as friendly, and it came out 30 minutes after the open, so it wasn't right when we hit the bottom. But this might have been used for some justification for the buy the dippers to come in and say, oh, sentiment's improving, let's buy, and drive prices back up. But it didn't work out in Friday's session. Here is the chart. I don't have the second chart that I usually show that goes with this economic report. It wasn't updated, so there's really no reason to show that chart. But this breaks it down into three different areas. The blue line is the total reading, and that's improving. And then how people are feeling right now, purple. Okay, they're feeling a little bit better. And then how are people feeling looking down the road? That's the yellow line, and all of these are seeing an improvement. All right, then we go through our IsabelNet blog charts. This is the 4-week average of share buybacks put out by Real Investment Advice. And even though this is dropping off here, we're blue. That means that companies are at least looking at doing buybacks, and that's seen as something positive. When a company is willing to come in and buy its own stock, it's like, okay, we have confidence that our stock's going to go up because this goes over into their books as well and makes their earnings look better. They're probably not going to come in and buy their own stock if they're afraid that it's going to continue to decline. But it has been dropping off lately. But the takeaway here is that it is still positive. Okay, and then once a company comes in and buys its own shares, that makes fewer shares available on the market, and that makes them more precious. Yeah, it's just a nice little golem thing that happens there. Now, I'm not going to read all through this, but how do stocks do after major events? Okay, geopolitical events, major historical events. This goes all the way back to World War II, and then carries through. And then sometimes things were good, sometimes things were bad. Looking at the bottom, though, 1 month out when something negative like this happens, we're usually down, and even 3 months, we're usually down from there. But often we'll see a positive median return. And then the further out you go, it's still not great. 60%, 68%. That's not much of a lean in the positive direction, but it's slightly positive there. And then the returns end up being better the further out you go as the market has a chance to recover. All right, then aggregate financial asset allocation across household. Most households, 53%, own stocks, whether it's through a pension plan, whether it's through a Roth IRA, whether it's in some kind of a retirement plan that they have, or maybe their own portfolio. Stocks are still seen as the way to go. Debt, that's bonds. It's actually been dropping off. And then cash, those that would be like savings accounts, CDs, money markets would kind of be the bigger one there. Okay, the main beneficiary of de-dollarization is gold. Now, you could also say the main disadvantage of the dollar going down or of gold going up is the dollar going down. So I'm not sure quite what they're thinking here. And I'm not quite sure what they mean by de-dollarization. Now, there's rumblings out there that the U.S. might lose its U.S. reserve currency status. You can make a case for either side on that right now. And I've heard both sides of the argument, and we'll just keep an eye on this and see how things play out. But as the dollar has been going down, gold has been going up, and that's not a real surprise there. Okay, then Goldman Sachs came out and said we've raised our 2025 quarter over quarter GDP forecast to 1.25%. Where they, okay, all right, whatever. But basically, what they're doing is they're raising their GDP forecast and they're lowering their forecast that we're going to go into a recession. That's all they're doing here. Then the dollar has been tracking U.S. inflation surprises since February at their lowest since whenever that happened. So, yeah, if you look at inflation and the dollar, okay, there's more inflation surprises anyway. There seems to be a correlation between the two. All right, then the S&P 500 returns at this point in time over just 2 months from a 1.5 standard deviation. That's when we hit the low in early April. The recovery post on Liberation Day shock is the strongest. Okay, yeah, this is just, we've bounced up nicely out of that real drop that we saw. Then earnings yields drop below bonds, and this is typically seen as negative, but most people don't use stocks. You might have some dividend stocks, and you may really rely on those, but most people tend to use stocks as a form of capital gains, buy low, sell high, where then you switch over to bonds, where then you're using the interest that's your main goal at that point. But this is getting to a rather low level as the stock market had been going up. And then S&P gets closer to all-time high. Yes, tell that to Friday. So we were still dealing with the 6,000 level, and we still have a little ways to go to get up there. And we might give it a shot, but maybe the market's going to go through a little bit of a bumpy time, especially if we stay in this non-trending environment. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, so here is the chart. We gapped lower, not a real surprise there. And then there was initially some buying right at the open, but that went down. We fell below S2, but right here at 59.75, we found some support. And then this is when the amateurs, anyway, the earlier folks, they were trying to buy the dip here. And it looked like it was working. It was working. It was working. They got it back above S2, back above S1, and then we hit 6,025. Now, this wasn't a pivot point, but it is a round number that people tend to focus on. And you might have had a lot of the algorithms, the computers that trade automatically. They said, okay, if we bounce back up to 6,025, start selling like crazy because that's pretty much what happened. And so then we got done with the open here, and then when the smart money started to come in, they just sold, 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 got back down below S2, even broke and set a new intraday low. And then after that was done, we just kind of chopped around. There were some attempts to buy the dip down here, but it really didn't work out, even though we did close just a little bit above the 59.75 level. And things are settling down a little bit as we close down for the weekend. There's real concerns about things that could develop. So we'll just watch things as they open Sunday evening. Now we are seeing a drifting down here of both growth and value intraday. We're a little bit concerned because the blue line, even though it's still above the red line, it's not as far away from it. Now they're on different scales, but when we're looking more positive, the blue line is above the red line. And it still is here, but it's not as far above it as it was before. And this actually is more positive. Even with the down day on Friday, we're not really starting to drift lower with our S&P growth to value ratio. For right now, this is holding up. We were more positive if we go back to April and see how this had really been climbing. And then pretty much since June, we've been flattening out with this overall ratio, which is more negative because we got into a non-trending environment and we're not really having the juice to break to the upside, but we're not breaking down at least yet either. So there's a positive side and negative side here. So everything ended up being down, with growth being down more than value with the large caps. It was down more with the mid caps and about even, but one tick more with the small caps. So we look at our end of day small cap to growth versus growth and value, our ratio. This is still holding up, and the mid cap growth to value ratio is still holding up, and the S&P, even though it's dropping down now, it's holding up for the most part. And we just recently generated a golden cross with this ratio, so the trend has now switched back to positive of growth to value end of day. And fell back a little bit, but we're still above the majority of the rainbow with this growth to value measure. And coming back down to the 200-day moving average, when we look at discretionary versus staples, we want this to go up. That would be more positive. If we see more weakness here, naturally that would be more negative. So here we're trying to turn up in the short term with the ADX chart, but just about the time we were turning up, we had the down day on Friday. That's bringing the short-term ADX back down, meaning that we're not trending, but we still default to positive because the green line is above the red line. And that same thing here with the intermediate term chart. And this is the one that I really focus on the most. We were trying to turn up. Now we're going back down, but we're still positive with the green line above the red line. But the ADX is still not only below its moving average, but also continues to be below 20. Still below average with volume, which on a day like Friday could actually be taken as positive. But we've been seeing nothing but below average volume days now for the last while here. Okay, sentiment, we're back above 20 with the VIX, and that is more negative on an annualized basis. So we'll see if we can get back under that if we see any kind of a bounce. And the VIX of the VIX, which had been starting to actually lead the VIX a little bit here. This is the volatility of the VIX. It was starting to go up before we saw the VIX itself starting to climb back above 20. And I haven't shown this in a few days because we were flatlined as far as momentum with the MACD. As what is the momentum of the VIX? Well, since it shot up back over 20, we're starting to turn back up with the momentum of the VIX. We went up with this fear gauge. We also went up with this other fear gauge. That's a confirmation there that some fear is coming back into the market. And this is not really a surprise here. The one-day chart for the equity put call ratio, you probably had a lot of hedging going on ahead of the weekend with a lot of the concerns out there. And so we're going back up with the 5-day chart, and we're also turning back up with the 10-day chart. So there's some hedging going on in the market. And we actually leveled off here, but slightly above the range with the volatility risk premium. But this has been coming back up. But at least in Friday's session, it leveled off. Advanced decline line, even though it was down, still looking positive in the bigger picture. We're declining, but still above zero with the advanced decliners oscillator. And we're dropping a little bit below zero with the short-term advanced decline ratio. We're declining, but still above zero with the intermediate term advanced decline ratio. And Seeing a dropping off here of the new highs, a little bit of an expansion of the new hoes. There you go, new lows. But we're starting to roll over and actually look a little bit more negative with our 5-day chart. We're slightly declining with the 10-day moving average chart. Now, if again, and I point this out every time, if you're looking at the accumulation distribution, which is a smart money indicator, you are still positive because we're above this advancing moving average. But a little bit more short term would be the boom indicator, which has been just trailing along this red line. Well, with the accumulation distribution coming down, we've actually dropped and are turning more negative in the more aggressive approach with the accumulation distribution. More conservative, a little bit longer term, you're still positive though. All right, now we're negative with the Chaiken Money Flow, and we're back to negative with the Chaiken Oscillator. So our three smart money indicators have now turned back over negative. And we actually, this is kind of encouraging. We're still going up with the green line with the vortex. We're declining with the red line. So this is still positive. Now, I've been pointing this out too. This is a bit longer term. 10-day average of the highs and lows for the S&P. We got above this green line and then we started to come back down. We've actually dropped below the green line now. So there's some weakness that's starting to come back in there. We did decline with all of our advanced decline lines, but we're still above the moving averages. We're dropping below 50 now with those stocks in the S&P above their 20-period moving average. We declined, but we're still above 50 with the 50-period moving average study, the 100-period moving average study, and we're just a little bit below 50 with the 200-period moving average study. Here it is. Now, I was trying to point this out too, as we were coming up. We hit this dashed line, which is the pivot point, and that's overhead resistance, and that's where we set the high earlier in the week. And since that time, we're starting to come down from that point. And another thing I was pointing out is that we were setting a series of higher highs and higher lows. For the most part, when you look at this chart, are we starting to break that now? Are we going to keep going down from here? We could still recover from this. We haven't really broke out of this pattern of higher lows here, but we're going to need to see some kind of a bounce and then eventually get above this dashed line if price is going to have a shot at getting back to the all-time high here. We're not that far away from it. So we'll see if this positive bias can start to come back into the market. We continue to be below average with volume. And we declined with the 20, 50, and 200 period moving averages. We're slightly below 50 with the 20. We're just above 50 with the 50. And we declined and we're above 50 with the 200. So not a lot of technical damage was done there. And then after Wednesday, Stochastic RSI, extreme positive. Excuse me, after Thursday, extreme positive. Then after Friday, extreme negative. See how touchy this indicator can be? And we're no longer extreme with the Williams percent R. CCI 14 is now dropped out of being extreme, and the CCI 20 is also dropped. This is the one that's a little bit of a lagger. We're no longer extreme with the short term. We're still extreme, but coming down in the intermediate short term. We're just starting to roll over with the longer term, short term stochastic chart. And we're still just barely positive here with the force index. We're a little bit above the midpoint. Now we'll see if some damage is going to be done to the short-term trend. We had been going up here with the green line and the blue line. Now that we're spending the last couple of days below these lines, are they going to begin to roll over and start to come down? Not a lot of damage has been done to this point, but if we see more declines from here, those are going to roll over. And we're now down into the +1 channel, where we spent a lot of time up here in the +2 channel, even got up into the +3 channel for a couple of days. But now we're coming back, but we're still above the advancing midpoint with our standard deviations chart. And we're declining, but still above zero with the balance of power. We closed a little bit below the short-term moving average here, the green fluorescent one, but it hasn't started to roll over, at least yet. And we've gone from darker blue to lighter blue with the no-go. The no-go, so that's turning a little more negative. Coming down off of the blue line, which is the highest high value, but we're still above the midpoint. We're still in an uptrend according to Landry Light and the proper order. TTM squeeze, it was looking a little bit better after Thursday. We were turning to the lighter shade of blue just like the song, Lighter Shade of Pale. Now we're turning back to darker blue, and that's a little bit more negative. And now this is interesting, though. We were going up, and the ease of movement was just kind of trailing along the zero line. We had a down day, and now the ease of movement is actually going up just slightly. We're still positive with the Arun since we're above the zero level. And now we've gone back to being negative again with the McClellan oscillator for the S&P. We were slightly above zero. Now we've dropped down below zero. Hard to see, but well, I guess it's a little easier to see now. We're starting to go down based on price, and we've rolled over based on volume. So this chart is now negative. And we're below zero with the NYSE McClellan oscillator. This is the one that's hard to see, just barely ticking down based on price and volume for the summation index for the NYSE. We had been positive with the Swenland Trading Oscillator. Now we're declining based on price and volume, but we're still above zero with both of these. And just kind of rolling over, but we're still above the moving average here with the PMO. But this is above the red line, so that's an extreme positive reading. We were improving based on price. Now we turn back down. We're still positive here, though, based on volume, even though it's turning back down slightly. So we're dropping further below 50, the midpoint with the PMOs that are rising. We're declining with the buy signals, rolling over just a bit, but not falling apart with the PMOs in the S&P above zero. We've gone from positive to neutral with the Elder's Impulse system. We're still positive with the parabolic SAR. We didn't see enough of an intraday drop to put the dot on top. So this is still looking positive. And after trying to turn up with the short-term oscillator, the slope oscillator here, we kind of are flattening out right now. We're still declining with the MACD. So we look at all of these, still trying to turn up, but could possibly start to turn down with the slope oscillator, rolling over just a little bit, but still above the moving average of the TSI. These are the two short-term oscillators. Then our intermediate term oscillators, MACD starting to drop a little bit lower, the PMO coming down to its moving average, the PPO also starting to drop lower. This, to me, is a little bit more of a concern, though. The tricks in the KST, these are long-term momentum oscillators, and they're still extreme positive, but they're starting to drift, with the KST showing a little bit more of a decline now. And we were improving with the copy curve, but we still haven't crossed above the red line. So it has not turned positive. We declined, but we're still in the green area with the Sean trend meter. We're still above 50 with the money flow. We declined, but above 50 with the ultimate oscillator. Still positive with on-balance volume. We're no longer extreme with the short-term RSI, but we're still above 50, and we're declining, but also above 50 with the intermediate-term RSI. Now, this is the first time in quite a while since we've been coming up out of this. We're seeing a little bit more vulnerability to the intermediate term trend based on 50 periods. As we were coming up, we came down to this red line, and that acted as support on the way up. We finally closed down below this. So we're going to be keeping an eye on this as well. For now, the red line and the blue line continue to go up, but the longer we stay below the red line, the more that's going to start to roll over. We're still above all the plotted moving averages here. We're getting kind of close to the shorter term moving averages, but this is still positive. And here's just kind of a bumper cars here with the bullish percent index just kind of chopping around. It did decline. We're still extreme positive, but we're probably, again, I like to look at charts where it's more blatant, where you don't have to really zoom in on something just to see what's happening there. So I would take this as more of negative, but chopping sideways. Declined a little bit with the NYSE bullish percent index, declining but still extreme positive with the NASDAQ 100 bullish percent index. And here's the spring bottom fisher. That might be going away here pretty quick. That one didn't seem to last too long. It hasn't crossed below its red line, at least yet. So we did come down to the top end of this mini rainbow, which is a 20-period simple moving average of the open, high, low, close. We went down a little bit below it, but quite often the area of these lines may act as support when we're going up and then pulling back. Then longer term, we did end up being down for the week. Excuse me. So we have a red bar here for the week, but still this is okay looking. We're still seeing even, and this is a weekly chart, which is kind of matching up with the daily chart. We're still seeing, for the most part, a series of higher highs and higher lows. So we haven't really broke that pattern, at least yet. And then we're turning a little bit more negative with the Heiken Ashi with the black candle. We're positive, but now pointing down with the Kegi chart. We're still positive with the Renko chart and looking a little more negative with the three-line break chart. And coming down, but still above the midpoint with our 150, and we're coming a little bit below the midpoint now with our 200 period moving average study. And this hasn't changed either. Still negative in the long term with the mid caps and small caps. Commodities are still positive in the short and intermediate term. Bonds have been back to positive now in the short term, where the dollar is negative across all time frames. The only sector that was up was energy because you had oil really going up. That ended up being positive, where we had the financial sector. And that's a little bit of a concern. And I'll show you a chart later that I've been showing. It's a ratio between the financial sector and the S&P. It's not showing a lot of strength right now, where everything else ended up getting hit. We had healthcare, which is more defensive, as well as utilities. They got hit less. But discretionary was down, communication was down, and then tech was also down. But staples were down too. So gold got back above 3,400. Not a real surprise there, given what's happening geopolitically. Oil got above 70. We're quite a bit above that now. And then looking at the alerts that were triggered during the day, we had energy having a BPI cross above 70. That's showing strength in energy. And I'll be going through all these ratios in the intermarket analysis video over the weekend. And then we had the NASDAQ going down below 19.6, 19.5, eventually 19.4. We did go below 6,000 with the S&P and the financials. BPI crossed below 70. So I'll show you that chart here in a moment. But awful lot of red here. And that's why we had the down day. All the bigger stocks, they pretty much got hit. Tesla was up slightly, but the big tech stocks, the communication stocks, they didn't have a really good day. And we're still seeing a bit of a disconnect here between the weighted version of the S&P and the equal weighted version. We want these lines to be closer to each other to see that the broader market is acting more in concert with the bigger stocks. They're actually seeing a bit more weakness than what we're seeing with the S&P itself. And so we're still continuing to go up with the ratio. When this is going up, that means the S&P weighted index is outperforming the equal weighted version. And we fell back down below the 200-day moving average with the Dow. We've turned to negative with the diamonds for the Elders Impulse system. And here's the NASDAQ. This was looking pretty good too. We almost got up to this R1 level, and now we've been pulling back down. Is this going to lead to more of a decline? Or we're still looking pretty good when we look at the higher lows here with the NASDAQ. And we've gone neutral. We're still neutral with the NASDAQ with the Elders Impulse system. Same thing here with the NASDAQ 100. It's still not a bad looking chart pattern that has been totally decimated at least yet. Now we see further declines. That's going to change. But this is still looking okay for the time being. And we're neutral with the Elders Impulse system for the Qs. The momentum for the NASDAQ 100 continues to be negative or down. And then, of course, with small caps. Had a good week last week, had a couple of good days this week, came right up to this R1 level, and have pretty much been giving back a lot of those gains now. And here's the Russell 2000 small caps, falling down to the 50 level with the RSI, came right up to its 200-day moving average, and now starting to fall back. The momentum is starting to roll over for the small caps as well. And we're negative with the Elders Impulse system for the small caps. Could not get above the 200-day moving average with the mid caps, and now we're falling back down. And this is also turned over to negative with the Elders Impulse system for the mid caps. Pulling back here over 1% with the Wilshire 5000, but still above the 200-day moving average. Also with the total U.S. stock ETF, pulled back, still above both of the moving averages. Financial sector, now by itself, it's doing okay. Now it's down over 2%. That's not a good day there. But where we're in downtrends with most of the major indexes that we follow, we're still in an uptrend here. The blue line's still above the red line with the financial sector. What's a concern is when we do a ratio with the S&P. And when we were really coming up, that means the financials were outperforming. And now, starting in about the early part of May, the financials have really begun to underperform, and we're coming down to the 200-day moving average with this ratio. Now, we might find some support off of this, or if we continue to fall down below it, That could be more negative. We just want to continue to keep an eye on this one. The FANG index did pull back, but it's still now in an uptrend. Apple, it ended up declining further below its 50-day moving average. Amazon was down, still above both of the moving averages. Google was down, still above its 200-day moving average. Meta down 1.5%. It had been doing better, just getting ready to generate a golden cross with Meta. Microsoft, it was down, but it's really been performing well since our earnings came out, and we do have now a golden cross for Microsoft. Nvidia was down, still above both of the moving averages. Tesla was up a little bit here and above both moving averages. And Netflix was down about 0.25%, still probably the strongest looking chart based on a trending basis of all the mega caps that I show here. And seeing a little bit of a drop off in the short-term correlation between US and world stocks, the longer-term correlation still continues to get stronger. And here's where oil jumped up into the mid 70s now. We actually got down into the high 50s there not too long ago, and now this is starting to go up. If there's a continued escalation, if something happens in the Strait of Hormuz, that could really continue to push oil prices up. The dollar continues to be in a downtrend. And now Trueflation is coming out. They're back up over their 2% level with how they figure inflation, where the latest reading we had was at 2.4%. And we're still below 4.5% with the 10-year yield. So even though interest rates went up, we're not getting into that red line area right now. And still above the 50-day moving average with the 10-year based on price. And seeing a bit of a pullback with our growth to value ratios. More weakness here with discretionary to the S&P, pulling back but still above the moving average when we compare large cap growth to value. So we're falling a little bit below the moving average with the large caps, coming down but still above the moving average with the mid caps, and actually bouncing off of the moving average with the small caps. Okay, so what's the outlook then for Monday? Haven't changed the overall conclusion. We're still positive in the short, intermediate, and long term, but we're not trending. And then we're going to get the Empire State Manufacturing. That's more for New York, not a real major report. And then anything geopolitical, either domestic or something that happens in the Middle East. You know, there's Russia, Ukraine going on too. We always want to keep an eye on that. And if things really start to escalate, that could be negative. And here is the upcoming calendar for June 16th through the 20th. We'll get retail sales on Tuesday. And then Wednesday is when the Fed's are going to come out and make their announcement. And then there's that Juneteenth. I'm still not really sure what that is, but please don't tell me. I prefer to stay in my ignorance with that. But Thursday, the market will actually be closed, but we're slated to have initial jobless claims and continuing claims come out. That I don't know how that's going to work. And then Friday will be the Philadelphia Fed Index and then LEI. Not really major, but I try to keep an eye on the leading economic index. Okay, here's a look at what the previous readings were for the important reports and then what the forecasts are for those reports. Seasonality, not too bad for June 16th. Neutral to positive with the Dow, where we're positive with the S&P and NASDAQ. We are coming into options expiration week. That'll be on Friday, June 20th. Where we're up a little bit more than we're down. 55% of the time up, 45% of the time down, going back to 1980. And then but when you look at post-election years and break those out, according to the Stock Traders Almanac, the green dashed line, we do see some weakness now going into the latter part of June. We might get a little bit of a bounce later in June, but this is a little bit more negative from a seasonal perspective. All right, then we look at the three smart money indicators, which are now negative. Discretionary to staples is still negative, and the S&P and NYC McClellan oscillators and summation indexes are also negative. The Copic curve trying to improve, but still negative. Swanland trading oscillators now back to negative, as is the longer-term special K chart that I show over the weekend, and the momentum for the NASDAQ 100. Then on the positive side, we do have a recent golden cross with the growth to value ratio for the S&P. That's the longer term end of day chart. And we're negative with the bullish percent indexes. We're below the moving average. That's why I have that negative. But we're still extreme positive with the NASDAQ 100 and NYSE bullish percent indexes. Parabolic SAR is still positive. The momentum oscillators, they're kind of positive, but they're just drifting and showing a bit of weakness. I could have put this over on the warning side. Ease of movement, money flow, and ultimate oscillator are still positive, as is the vortex, and actually showed some improvement on Friday. Financial sector is positive when you look at it by itself. It's just giving us some concern when we compare it to the S&P. And then the Pring bottom fisher buy signal, it's kind of might be going away here pretty quick. And then here are the pivot points for Monday's session, which have been updated on the YouTube community tab. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So our conclusion, I haven't changed it. We're positive across all time frames, but we're not trending now. Thank you. Have a wonderful, safe, and sane weekend. And I will talk to you many times over the weekend with the weekly video, intermarket analysis video, deep dive video, and the what to watch video. So have a great one, and I will talk to you many times over the weekend.